the Treasury will present for about 20 minutes, and then we'll open up for a moderated question and discussion session. And if you're online, and if you can't hear me, we would invite you to put your questions in the Q&A chat. And if you really like them, you can put a like on them, and I'll make sure that those are the ones that get priority. We think we should go. Right, so just repeating those for you online, just Iain will talk for about 20 minutes. Please put your questions in the Q&A chat, and we will moderate the questions at the end of that. So with that, ngā mihi nui ki Iain Rennie, the Secretary of the Treasury. Please, Iain.
Thanks very much, Struan, and I'd also like to acknowledge everyone who's in the room with us and everyone online, and also give you my acknowledgement to the hosting from Minters today. What I'd like to do in this presentation is essentially draw out, I think, some of the key observations and points that we as a Treasury have reflected on as we've prepared the investment statement. This is the third of 3 stewardship reports that we've brought out this year. They are the long-term insights briefing, long-term fiscal statement, and now the investment statement. And while they look at somewhat different dimensions of the public finances and fiscal policy, there are a series of quite consistent findings across the 3 documents. And the key points are that government finances are under pressure, public debt in New Zealand is trending upwards, and absent of policy changes, our fiscal position is on an unsustainable path over the long term. Fiscal pressures are already significant, and they're expected to accelerate in coming decades, particularly with respect to the costs associated with the demographic transition, increased longevity, falling birth rate, and a high proportion of older New Zealanders in the whole overall community. However, while these challenges are really significant, a key finding of all of our statements is that New Zealand retains a number of options to successfully manage those challenges. There is no one solution, and successive governments will need to think about pulling a number of levers to deliver fiscal sustainability in coming years, looking at expenditure, revenue, and what we'll focus on today, the Crown's balance sheet. We can't and we don't need to fix these multi-decade issues in one go. But the final, I think, key message that we'd like to leave you with in terms of a summary of our 3 documents is that the earlier we take policy decisions, we disrupt the community more generally less, and we lower the cost of the adjustment. So that, in the Treasury sense, is why we've got a degree of urgency about the need to begin to make policy changes. Small changes can compound to big results over the medium to long term. One of the characteristics of New Zealand that I think our long-term insights briefing in particular drew out is that shocks in New Zealand context are frequent, they're becoming more frequent, and we expect those shocks to be ongoing. The slide reflects a number of the different kinds of shocks that New Zealand is subject to. Some of them are very specific to New Zealand, and biosecurity shocks like Mycoplasma bovis. Others are the New Zealand impact of global shocks such as COVID-19. What we've found is that government's responses to those shocks on average have amounted to about 10% of GDP per decade since the 1980s. And it goes from quite small events. So, for example, the North Island weather event in 2023, the government's response was about 2% of GDP, through to the Canterbury earthquakes, where the government's response was about 10% of GDP, through to COVID-19, where the government's response was about 20% of GDP. So the rule of thumb is the combination of small, medium, big shocks is around 10% of GDP over a decade. One of the findings of the last 15 to 20 years is that public debt levels have ratcheted upwards, and it's been a consequence that both shocks are more frequent, so it has been harder for governments to save and rebuild buffers after a shock before the next one comes through, but also in if you like, the period between shocks, we haven't saved enough to rebuild our buffers. So that's an important insight about the need going forward to think about risk in the New Zealand economy. Out of the long-term fiscal statement, we have a number of projections about what the next 40 years could look like. Now, there's a degree of humility here. Economists quite often are challenged by forecasting what happened to the economy 3 months ago, let alone what's going to happen 40 years into the future. But having said that, we've got a high degree of confidence, particularly around the demographic pressures that are changing. We can put a degree of quantification around those. And in the long-term fiscal statement, we look at different scenarios, some more optimistic than others. But the net result is the same, that public debt, which is just over 40% of GDP today, in our central projection reaches about 200% of GDP by 2065 in the absence of policy change. Even on a more favourable outlook, that's still to about 100% of GDP. So our key message is that there's a high degree of certainty about at least the direction of some of these pressures, and that's why there's a real value in governments now beginning to address those issues, even though the details about the future obviously are clouded in a lot of uncertainty. Turning to this investment statement, the balance sheet is showing itself to be much more important and complex than we've thought about previously. So over the past decade, the balance sheet of the government has grown in scale and changed in composition very significantly. Both assets and liabilities have roughly doubled in value. So if you like, the balance sheet is just much bigger. It's also more complex. It's contributed to by a wider range of entities in the public sector. The central government owns about 7% of all assets in New Zealand. So in a national context, we, the government, are a very significant owner of assets. And at the same time, we also owe a lot of liabilities. We owe about $380 billion of liabilities. So over the past decade, assets have actually increased faster than GDP. So they've gone up from about 108% of GDP to 136% of GDP today. And liabilities have gone from about 74% of GDP to 90% of GDP. So the balance sheet is bigger. And so for us as a Treasury, we're finding that we're focusing much more on the balance sheet. And I think what it means for successive governments is governments have got to think and put more time and policy work into thinking about how the balance sheet works and the key aspects around it. Just to kind of cue people in about what our balance sheet looks in simple terms. So let's look at assets at the moment. So roughly we've got about $570 billion of assets. Roughly half of those assets are physical assets, so that's things like buildings, land, infrastructure. Most of the remainder are financial assets in one form or another. So that's, for example, investments in New Zealand Super Fund, its advances, for example, student loans. So that's what the asset side of the balance sheet looks like. On the liabilities side, the $380 billion I mentioned a moment ago, about 2/3 of that are borrowings. It's the public debt. Then the rest of the liabilities cover a range of items, but the biggest significant one of just under 20% are insurance liabilities related to liabilities of ACC. So when you look at going forward, the investment statement says, well, what could the balance sheet look like under some plausible scenarios. We use the firstly the forecasts that we published in the 2025 budget and economic fiscal update, and beyond that projection period, the investment statement projects out what net worth could look like over a longer period of time. And as you can see from the graph, net worth as a percentage of GDP has increased over the past decade. We're expecting that to turn around and for net worth as a percentage of GDP to decline roughly from about 45% of GDP today to about 24%. And there are two key parts around that deterioration. Firstly, through most of this period, the government is financing or projected to finance operating deficits, and so therefore liabilities build up over time. And whereas over the past decade, both our physical assets and our financial assets have increased in value relatively rapidly, we're expecting that pace of increase in valuation to moderate very significantly over the coming decade. So those two factors in combination mean that while net worth, if you like, in nominal dollar terms is broadly similar, it declines quite significantly as a percentage of GDP over time. And there are a number of other ways to look at the balance sheet, and the investment statement looks at other measures, for example, financial net worth, net debt, comprehensive net worth, and they all tell a very similar story, that over time the balance sheet is going to become somewhat weaker, and that reflects the underlying deterioration in the fiscal position. As I mentioned, shocks are a really important part of thinking about how do you layer over shocks on top of that trend. And I think one of the really interesting parts of the investment statement is we look at a couple of different kinds of shocks that could hit the New Zealand economy. So we look at a severe Hikurangi subduction earthquake, and we also look at a global trade policy shock. So two quite different shocks, but two quite plausible shocks that might hit New Zealand in the next few decades. And so the graph shows the impact on debt above that sort of central projection of a significant earthquake, and that in that case borrowings increase in the first 5 years after the earthquake by about $115 billion, which would take our net core crown debt from about, as I said, just over 40% of GDP today to roughly 73% of GDP. So that kind of gives you a sense of the magnitude that particularly large shocks can pose to New Zealand going forward. In the case of a global trade policy shock, in terms of the balance sheet, we're more likely to see a somewhat more contained impact on the balance sheet, particularly through the valuations of financial assets that the Crown holds. So let's dig a little bit more into the elements of the balance sheet. And we separate the portfolio into three components: a social, commercial, and financial portfolio. So social assets essentially provide public services like transport, housing, education, and key points that we make in the investment statement is that in a number of cases we don't manage our social assets very well. For example, the average age of our hospitals is around 45 years, and they have a typical life of around 50. A third of our schools is over 50 years old, and the evidence that we have is that there's significant variation in the quality of those assets across the country. So a key point that comes out of looking at the social portfolio is the need to gather better information about the condition of our assets, ensure that our agencies that have responsibility to maintain those assets have the capability to manage those assets well, and to ensure there's sufficient capacity in agencies and across government to perform that work well. And that includes the Treasury. We have a responsibility in terms of the management of the investment management system overall. And so there's a message for us as much as there is for agencies that are delivering assets. Turning to the commercial portfolio, here there's a reasonably wide range of entities of a commercial nature that are in the portfolio. So some of those are state-owned enterprises. It also includes the mixed ownership model, companies that are both have government ownership but also have listed holdings in the share market in New Zealand. What the point is that we make here is there's roughly $100 billion of assets in that part of the portfolio. So their performance matters a lot. And what this next graph shows is that certainly there's some evidence to suggest that we can be doing a better job to improve the performance of that portfolio. And this graph shows that those commercial entities that are listed in the portfolio that are listed on the stock market have consistently outperformed the New Zealand Stock Exchange. The ones that are not listed haven't met that benchmark. And so, we need to look very closely about the performance of assets in the portfolio, to think about the ways in which government can enhance the performance of those entities, whether that's through maintaining ownership of those entities, clarifying the purpose which government is using to continue holding those entities, or thinking about a framework about whether some of the capital in those entities or all of the capital in those entities could be put to better use elsewhere. So as a message for government, because of the size of these commercial entities, this $100 billion, the need to regularly review the performance of that part of the balance sheet, including the objectives of Crown ownership. And then we look at the financial portfolio, and it's on the asset side, it's increased significantly in the last few years. So here we've got financial portfolio assets like those held with ACC and the New Zealand Super Fund that help to fund obligations, whether it's in the case of ACC in terms of liabilities over time, or in the case of the Super Fund, helping to at least pre-fund part of future superannuation obligations. And in the last few years, the performance of those assets has tended to exceed the expected rate of return. Obviously, projecting asset returns over the medium to long term going forward is a heroic exercise, but our expectation is that rates of return are likely to be somewhat lower going forward than we've seen in the last few years, and that reflects the very high asset valuations that we see in a lot of asset markets, both internationally. With this part of the portfolio over the last 20 or so years having grown very rapidly, the investment statement makes a point that we not only need to think about the risk that particular parts of the portfolio hold and how we manage that, but also to get a more holistic sense of how the risks of our financial portfolio in and around impact and move across the balance sheet. So it's a story about, we've had some good performance, but we're certainly not complacent about the issues that are in that part of the portfolio. So to pull all this together, where does all this leave us? As I said at the start of the presentation, the combination of the stewardship documents and also the reflection of the balance sheet through this particular statement are showing the same thing. Our fiscal position has deteriorated significantly over the last decade, and that deterioration is likely to persist through time unless policy change is made. Future shocks and demographic changes will continue to put pressure on our fiscal position. While there is some uncertainty about the timing and extent of that future pressure, we're reasonably confident about the direction in which those pressures are pushing the government's finances over time. Because the balance sheet has become much larger, much complex over a period of time, it's a much more important piece of the fiscal puzzle for governments to think about how it's working, and therefore what are the levers available to government to get better performance. This means we're going to have to put much more effort into managing the assets we own better, making better decisions about new assets, and ensure we better understand and manage the risks government is exposed to. This will require some choices from future governments. We've said that there will need to be a number of levers pulled to be on a fiscally sustainable position, and that includes the balance sheet, but it's not restricted to the balance sheet. That means regularly reviewing assets to ensure they provide good value for money and are fit for purpose, better maintenance of our existing assets, and divesting in assets we no longer need or where capital could be put to better use. So that in a summary is our investment statement. I'd like to conclude by acknowledging the Treasury team for what I think is a really fine piece of work over a number of months. So I kind of acknowledge my colleagues in doing that, and very happy to take your questions or comments. Thank you very much.
So I now invite questions from the floor and also online. Get Iain to talk about that. We'll have a discussion, and also just to acknowledge that our hosts have offered us a cup of tea and coffee afterwards. So those of you who wish to linger at the conclusion of the formal parts, please feel free to do so. Let me open up the floor, with the threat that I'll ask the questions, and they'll be particularly difficult.
How are you thinking about climate change risk?
So I think there's we do talk about that in the investment statement. We're already seeing it, and it comes through in a number of angles. So when I talked about shocks, some of those shocks are climatic in nature, and we know for New Zealand, one of the consequences of climate change is a greater frequency of severe weather events. So we're already seeing that, and we expect to see more of those kinds of events. Some of our messages about better asset maintenance, better decision making about new assets reflect climate change into that. So it's actually how do we make sure that our assets are resilient to the kinds of shocks that we will see in the economy. What does climate change mean for government's decisions about new assets, where it puts assets, the nature of those, the robustness of those. So climate change, I think, feeds itself through into a lot of the themes that we talk about in the investment statement, and I think we see it very much as one of those key pressures in addition to demography that are going to be pushing the public finances in the sort of directions that we're talking about.
Thanks, Iain. There's a couple online, but this is a tough question, but I'll read it out. So what is Treasury's role in modelling some significant policy options to address the pressures you've identified, which are likely to be proposed by future governments? For example, major changes in fiscal policy. While tax is one, would you seriously model others, such as a significantly expanded social insurance scheme for core services, such as super, health and education?
So I think, there's a couple of things there. One is to reflect on the role of the Treasury. So, our role as an economic financial advisor to whoever is in government. So, obviously a key role for us is with working with whoever's in government around changes in fiscal policy settings, whether on the expenditure side or the balance sheet or revenue. So that's sort of part of our role, particularly in a long-term fiscal statement where we looked at your potential solutions to the challenges we see in long term. We did a number of, if you like, what ifs, which we're not sought to be comprehensive about the kinds of policy responses, but we were indicative of the kind of policy choices that will be in front of governments. And if you go to the long-term fiscal statement, there is modelling there about what happens if you change tax settings or expenditure settings, superannuation settings, and that's very much for us is trying to inform the public discussion about the nature of the kinds of challenges and the potential magnitude over time. So I see ourselves having that sort of two roles. One is the first and most important is supporting the government of the day around the agenda. And then the second bit is what I see as our kind of stewardship role, which is to contribute to the public debate and information, so that actually there's a better understanding about at least the broad choices that face New Zealand going forward.
Thanks. Another one from online. Why should a social insurance scheme have an outstanding claims liability? There's a fundamental discrepancy between the treatment of ACC and New Zealand Super. What difference would it make to net worth if the OCL for ACC is removed? Handily, our staff has provided an answer already in this, but I think there's a bigger question in there for Iain as well, because of course we comply with GAAP accounting rules and they require us to do that. And ACC is funded as a save as you go scheme to ensure people are getting cover, so we need to recognise that. However, I think underlying the question, there's a bigger question about what should we include or not in the absence of accounting rules. Have you got any further observations on that, Iain?
I think one of the reasons is, it's really important, I think, that our starting point is generally accepted accounting practice, because I think there's a high degree of credibility and transparency that puts around our accounting. But like any framework, it doesn't give you all the answers. So there are other ways to look at the fiscal position over the longer term. And that's why I think you're seeing in a range of our documents that we're kind of trying to go beyond what accounting standards require us to do to project some changes. And so that's not saying we don't, it's sort of saying to give a wider and fuller picture of the state's finances over the longer term.
Can I just ask a related question to that? How does this statement deal with contingent liabilities? So we've potentially got one in terms of our commitments under the Paris Agreement, for example, that is currently contingent, not included on our books. How does the Treasury treat those when you're looking at this investment statement?
So we're explicit that we don't. So we're just using accounting information in here, but we acknowledge that. It's also important to acknowledge on the other side, there are contingent assets that we don't as well. Yes, we've spent a lot of time looking at the accounting treatment of potential liabilities under the Paris Agreement, and we've spent a lot of time with the Auditor General working this through, and both of us have concluded at the current time it is appropriate that we're not recording that in the core Crown books.
Thanks, Iain. In your long-term, I think it was the long-term fiscal briefing, it showed the fiscal cliff approaching us, and even with economic growth, and there are assumptions about economic growth in there. So I read that as saying we can't, under normal assumptions, even grow our way out of this fiscal problem. I want to draw a link to your slide about the commercial assets of the Crown, where the listed commercial assets were generating higher returns than the fully Crown-owned ones, and just sort of what, I draw an inference on that on our productivity problem round to economic growth and Crown ownership in the economy, and just Treasury's thoughts on that linkage.
So in terms of your first point, I mean, we'd say currently, and we've said this publicly, we have a structural fiscal deficit, and so what that means is that even when the economy is back to full capacity, the deficit won't be completely removed. So don't get me wrong. I mean, growth is good. It helps a number of decisions, but we're not going to kind of grow our way out of the fiscal deficit by itself. So there'll be a need for ongoing changes across the balance sheet, tax, revenue, expenditure to do that. So I think that's the first point. I think the second point is the observation, I think, is around how do you get better performance on the commercial portfolio. And I think it is an observation to say that actually, I think that the fact that some of our entities are at least partly held in the private sector, there are benefits that come with that, in terms of the focus of boards, the accountability of boards to investors, to shareholders above and beyond the Crown as a shareholder. And I think certainly, one of our reflections is that that is one of the values of the mixed ownership model, is that you can leverage some of the increased disciplines of, if you like, private sector ownership into a public sector construct. And so I think it's a model that has some advantages from that perspective, and that's why we kind of think, again, it's another one of the options for government to think about, because it's, as you say, it's not just about financial performance, but then how that flows through to the use of capital, ensuring that new investment is appropriately kind of commercial in terms of its returns. So it links into an economic story as much as a fiscal story.
Thank you. My question is probably related to that, because I was interested in total shareholder return and how you think about that in an unlisted context when I'm not sure which entities are in there, but they may have not only a commercial objective, they may have a social objective or a decision that a government has made in relation to that limits somehow their revenue, et cetera, et cetera. So just wonder how you think about total shareholder return in that context, whether you ignore it, whether you start to put some dollars around it, and what other disciplines one might use going forward to measure performance.
Can I just add to that too? Because one of the online questions is what progress has been making requiring state-owned entities to write purpose statements, which is all about ownership purpose and where we're taking that.
Well, that's right. I mean, and I think one of the values I think about the current exercise about ownership purpose is that it's probably for the first time really trying to assist governments to work out why they own the entities that they do. Is there a public policy reason, and if so, what is it? Can that public policy rationale be met just through ownership, or could you use other levers like regulation or funding to achieve the same purpose? And so we're partway through that exercise with the government, and I think that will assist that sort of clarity about what's, if you like, what's the nature of the shareholder return. And then having gone through that, I think it'll be easier for the government to articulate those entities that says, no, we really need to maintain ownership because we're trying to achieve these kinds of objectives, in other entities that may or may not be less clear. So yeah, that's essentially the mechanism, the exercise we're going through at the moment.
And from online, I think a really challenging but important question. all our work is detailed about having enough fiscal space to deal with some of the shocks and the long run trends. But the question really is, does Treasury have any plans to review or update or retest its assessment that somewhere around 50% of net core Crown debt is a prudent limit to what we would regard as a reasonable debt level?
So the last time we made our assessment was in 2022, and I think it's important to say that the 50% is a prudent limit in what we call normal times. So this is absent the existence of a big shock, and so I think I think periodically we will retest that, because I think we certainly think that the prudent level of debt can shift over time depending on your assessment of risk. So for us, the prudent level of debt is a level of debt where you could still get a big shock, but have a degree of confidence that you could kind of walk that back over time. And there are some choices there. There's choices about the extent of risk that you take. Obviously, as a Treasury, we're going to be probably on the more conservative side of that. But I'd say, in terms of the way debt's moved, we haven't been overly optimistic about projections of debt in terms of the debt's moved up faster than we've thought. So that's something we'll come back to through time. But I think we kind of broadly comfortable with the judgment that we took 2 or 3 years ago.
And maybe another quite challenging question, I think, too, that looking forwards in terms of infrastructure, should we be looking more to creating our own infrastructure bank to fund some of the big demands we've got on infrastructure?
So I come back a little bit to that question about and I think one of the interesting pieces of analysis in the draft National Infrastructure Plan that Infracom brought out a few months ago is that when you look at New Zealand's level of infrastructure spend in the public sector, it's actually relatively high compared to most OECD countries. Where we haven't done well is around the efficiency of that spend. So we're pretty much at the top for total level of spending and pretty much near the bottom for efficiency of the spend. So that at least sort of says it's not only how much you spend, but how well you spend. So I said one of our key themes is around ensuring that you make really good decisions on new assets. And so I think the question that you have to ask yourself about an infrastructure bank or whatever is, okay, what is it going to bring to the table that other investors aren't able to do, whether they're overseas investors, existing New Zealand financial institutions? What's the missing piece? So it's very much around the quality of decision making, information that's used, but that comes to a big theme for us is around the quality of decision making around investment, not just how much we invest.
And Iain, I know dear to your heart, but there's a question about the Reserve Bank in terms of financial assets, particularly over the COVID period. How much has that affected our balance sheet over the last few years?
I think particularly through the quantitative easing, and now we're getting a quantitative tightening, there've been significant losses that we are taking as a Crown. One of the things I do every month at the start of the month is write out the monthly indemnity to the Reserve Bank for the month's losses and so I've been in my job for less than a year, and I've already written out checks for much more than $1 billion, right? And that we estimate the cost of that to the Crown is about 10 billion. And that's reflected through in our balance sheet. Now, obviously, you have to think a bit about the benefit that came through that in terms of cushioning the COVID shock. The go forward for us is in terms of long-term fiscal statement. the long-term insights briefing, we still think there's probably about 45% chance that we might have to use those kinds of instruments again at some point over the next few decades. So part of our work program together with our colleagues at Reserve Bank is thinking a bit about how would we go about that exercise in the future, knowing what we do now with some of the lessons, not just actually from New Zealand, but other countries. So I think there's some big learnings for us going forward.
Another question is, the investment statement shows a rising value of social infrastructure, in part because of an increasing cost to replace, presumably from rapidly escalating construction costs. Are we adequately accounting for the increasing future liability resulting from this that inevitably arises with rising community expectations? And maybe I'll start this one off, but because I think a couple of things are important. I think that's a very salient point. I think rising community aspirations are going to be one of the things that it's hard to model, but that will come along with some of the trends we're seeing. The flip side of that, though, is we're very cautious. One of the points Iain made earlier is that revaluations, or the rising of those assets, has been very rapid. And what we have not done for land and buildings assets is we have not revalued those upwards or made any assessments about those in the future. So in a sense, it's symmetrical. We haven't made provision for the rising expectations on the one hand, but we also haven't for potential revaluations on the other. There is some good reasons for that set out in the investment statement, and that is that rapid increase, particularly around construction costs and things that we've had the last few years, that is ameliorating. So looking forward, it's probably a more reasonable assumption than it was in terms of future valuations. But, okay, that's fine. Another great question, I think, we've got massive public net worth compared to many other countries, and partly that's contributions to the super fund. There are also alternative uses of taxpayers' money, and the fund will have about 35% of GDP in mid-century. How does this fund prepare us for real resource investment needed for an ageing population? So what's the future of the super fund?
So the super fund is set up by legislation, and it's what's called a partial pre-funding scheme. So it helps to finance some, but by no means all or most of the increase in the super liability over that. Sorry about that. Of the super liability over time. So it does make a significant contribution, and so in the balance sheet as we go through, the build up in assets and super fund are reflected in our projections. So they're there. At the same time, and we make this point in the long-term fiscal statement, the super fund was only designed to be a partial pre-funding mechanism. So, and that's what it's doing. So that it certainly doesn't get away from the fact that there is a significant, if you like, unfunded portion of the increase in New Zealand super liability that will still need to be made by future taxpayers.
Thanks. Any other questions? Oh, yeah. So I'll go to Tim and then to you. So please.
Has the Treasury begun to speculate on the effects of artificial intelligence on the long-term fiscal outlook and the balance sheet?
I think the short answer in a systematic way is no. I mean, I think at one level, I think we understand that what we're seeing at the moment is artificial intelligence, and in connection actually with a range of other technologies, will have a profound impact on both the economy, but also on the public sector, how we deliver public services. So, I mean, my expectation is that when we have the next investment statement, I think you'll see more focus on it. I suspect through time you'll do that. So I think it's something for us where I think we as an organisation want to get a lot closer to what do these technological shifts really mean for us. But we're very much at the moment scratching the surface.
My question's about your role as advisor to the government of the day. Some of the policy responses are quite challenging for the government of the day, particularly given our short election cycle. So just wondering your observations on the extent to which there's a sort of cross-party consensus developing in terms of recognition of the challenge and some of the bigger policy responses that might be required.
Look, I think, I mean, part of why I think, we in Treasury put value on these documents is that I think they are a way to help support public conversation, including the thinking of political parties. Look, I think, I have to agree, and to be honest, I'm an optimist around where I think we will go on retirement income, because I think, we're beginning to see, I don't think we've seen consensus, but I'd say we're beginning to see the green shoots of consensus. So I think, you're kind of seeing emerging tendencies towards more as a save as you go kind of scheme, and that can look a bit different, but I think that's part of what we're going to. I think there's at least a conversation about what are the changes that you might want to make over time around New Zealand super. That is a more challenging conversation. And then I think there will be conversations about where does the super fund fit into that. So I think we're at the I suppose the early days. But I think part of for us as a Treasury is ultimately, the more that people are thinking about these issues, are debating what are the right choices. I think that for us is, I suppose, our responsibility in terms of supporting that conversation. And obviously, it's totally up to individual political parties about how they choose to respond to that or not respond to that.
Any other burning questions? I'm conscious of the time, so please.
Good talk, thanks Iain. We haven't talked much about taxation this morning, and arguably it's a little bit sort of peripheral to balance sheet question, but to what extent, when you sort of step back and look at the overall picture, do you say this can't be solved without tax increase? So sort of question one, and I'm just saying tax generally, more tax take. And question two, our tax take relative to overseas countries, where do you sort of start to get worried about competitiveness and wealth and income, moving in favour of lower overall tax destinations?
So two things. I mean, going to the point I make is I think to manage the challenges that we face, successive governments will need to pull levers across spending, revenue, and the balance sheet. Now, different governments will choose to pull on those levers to different degrees, but our basic point is, you're not going to solve these issues by pulling on any one lever. So coming to your point about, yes, tax is a part of that, and there's obviously lots of ways that tax can contribute. I think the second point that you make is a really interesting point about the balance between, at the end of the day, New Zealand governments are sovereign, and they can make choices about what level of public services are delivered in New Zealand and what level of taxes that are paid. At the same time, we live in a world where certainly capital and increasingly skilled labour is more mobile. And obviously for New Zealand, we have the particular set of arrangements is that we have this open labour market with Australia. So I think there's I don't necessarily think that's an absolute constraint on New Zealand governments, because we've typically had slightly higher tax GDP ratio than Australia for quite a long time. So it's not mechanical, but I think governments going forward will be needing to make choices about tax and spending in New Zealand from the perspective of what New Zealanders are wanting, and at the same time, how does that look in a world that's increasingly connected and interdependent for both capital and labour, and I'll then kind of weigh up the pros and cons of that.
I'm conscious we're coming to the end. It's fantastic. We're getting fantastic questions. There's 3 here that I haven't touched on, and I won't, because I'm going to throw in one final question to finish off. But the questions cover a lot. One of them is the 50% debt limit too high, given all the costs? Another one's around, could we manage QE and monetary policy better if we had our druthers again in terms of the Reserve Bank? And the third is, do we really need to intervene in the electricity industry through ownership rather than regulation? And so you can just see, I think, the breadth of issues that are coming out of this statement. But the final question I'll throw to you just to wrap up, Iain, is just, why now? Why do you think this this investment status is important right now, and why is the balance sheet more important than it's been in the past?
I think firstly, the point we make is that the balance sheet really has really grown a lot in the last decade. If we'd been having this conversation a decade ago, it would be quite different. So we've got a big change in our balance sheet, both in terms of level and composition. So it is confronting us all to kind of think a bit about how do we get the best value out of it. And so I think for us, that's a key message, is that this statement, as opposed to other statements, is coming up to, we've seen big changes in the past decade, both assets and liabilities. We now need to think about how do we generate the greatest public value out of the balance sheet going forward.
Thanks, Iain. Look, I really appreciate your time, those of you online taking your time, and those of you who've made the effort to come in here today. The document itself is live, so it's available on the Treasury's website if you don't have a physical copy, and there should be a link, I think, in the chat appearing now. For those of you who are here, I do invite you to wait around and ask further questions. You just see from the breadth of questions, I think, just the amount of interest of this. As a Treasury, we're really keen to keep the communication going, not just on the technical bits of the investment statement, but some of the broader issues that are coming through. So we're certainly looking for those opportunities, both here in Auckland and elsewhere. So please don't be shy in asking us to put our best foot forward. But again, a big thanks to our hosts and to Alison. Really appreciate their assistance in doing this. A big thanks to our team, and a big thanks for you, the audience. Thanks very much.